as well as on the overall outlook as far as asset quality is concerned. So Bianca, again, we were expecting some recovery this quarter, but till now all the PSU bank numbers that we've seen, asset quality issues are just going to get compounded from
Absolutely. That. Asset quality seems to be the main problem there, and that's also something that is now getting highlighted even more. In fact, CRISIL in its latest report has said as much, and CRISIL has lowered its GDP forecast, growth forecast for FY14 down from 6% to 5.5%. They're also expecting that industry services growth, they're going to grow at a much slower rate. Why so? Because CRISIL is calculating the growth numbers basis the impact of the recent RBI measures to tighten liquidity, that's going to have on economic recovery and on the challenges that now get compounded for India Inc. Let's try and get more clarity on this front. Mr. Ramraj Pai, President of CRISIL Ratings, is with us right now. Mr. Pai, thank you very much for joining in, and apologies there for making you wait for a little bit longer there. In your latest report, you've highlighted the kind of liquidity squeeze that, sort of heightens, how it heightens the vulnerability as far as corporates go. But in the backdrop of the recent RBI measures that have been taken, how are you quantifying the growth shock?
Yeah. So I think essentially if you really look at it, at CRISIL we are rating upwards of 11,500 to 12,000 companies, and our analysis really of this portfolio reveals that there are substantial repayments which are coming up in the region of almost 1.1 trillion rupees. And our models, what they show us is while about 65 to 70% of this money can be repaid through through profits and internal accruals, there will be almost about 30% or a third of the money which will need to get refinanced. Now, while refinancing has been something which has been commonly done by most corporates, I think the fact that a lot of this refinance will have to be done in an era of tight liquidity will mean that either refinance will become very expensive or much more expensive, or companies will not be able to really get into a mode where they'll be able to make those repayments. So all in all, cost of funds therefore will go up, and I think clearly it will impact credit quality for the banking system. So we are anticipating that credit quality on the banking sector will weaken, and all in all, I think what this will also do is that it will weaken the overall growth sentiment, and I think that has been one of the central inputs into, amongst other things, into the fact that we are lowering our GDP growth forecast.
So availability of funding at reasonable rates, that's definitely going to remain a stress point for corporates.
Yeah, it was something which was a stress point. It has in fact increased. And if you look at it on the foreign side, I think a lot of companies where you're really looking at the financing coming in from international sources, given the forex volatility and the issues, I think that also will become somewhat strained. So all in all, it's going to be a bit of a challenge.
Your report, I was just going through the report, and it highlights how credit quality pressures on corporates, they're going to continue, like you've just mentioned as well, given the difficult environment, and that the pressures are going to be greater on firms with higher leverage and longer working capital cycles. Which sectors or segments are we really talking about? Are we talking about power specifically? Are we likely to see increased number of restructured assets there?
Yeah, so I think, mainly, if I have to put it at a very high, broad level, I think it will really going to be the rate-sensitive sectors. Definitely power, capital goods, engineering, textiles, steel. These are some of the sectors that we are looking at. Clearly, these sectors will face a certain degree of stress. Most of the sectors I mentioned have had high leverage. That is going to be an issue. I also think that several of these sectors are seeing elongated working capital cycles. With their counterparties themselves, the people they're selling to, their customers themselves struggling. So, that is going to have a sort of rebound effect on them. But yes, broadly the rate sensitive sectors, and I think you mentioned power, definitely we do expect, significant issues in the sector, and I think, it will bring about some more restructuring in the sector.
Quite a bleak note there. You've spoken about how earnings downgrades are perhaps likely to outnumber the earnings upgrades that we are going to see in the coming months. Talk to us about how bad this ratio is likely to get, this ratio of downgrades is to upgrades.
Yeah, so I think this ratio of so the ratio, we look at is upgrades to downgrades, just to sort of provide a perspective. So this ratio was about 1.15 2 years back, which is about 1.15 upgrades to every downgrade. That ratio actually moved to 0.6. That was the ratio we saw in 12-13, which means to say that, we had 60 upgrades for 100 downgrades, vis-a-vis 115 upgrades for every 100 downgrades. So, the ratio sort of almost halved. And, while we did see some glimmers of some improvement in the initial part of this year, but the way things have moved, the way the interest rate sort of cycle has moved, the way liquidity pressures have built up, and I think more importantly, the way private sector demand is contracting. I think private sector demand growth at 4% is the lowest in many, many years we've seen. I think we do expect that, this ratio will be under further stress in the present year.
I'm just going to hark back to something that you mentioned a little earlier, Mr. Pai. The measures that the RBI has brought about over the last fortnight, even if these measures are, say, reversed by the end of 2013, any expectation or the window of a cut in repo rate that actually becomes smaller and smaller, right? What with WPI inflation also likely to raise its ugly head in the coming months given a weak rupee. So essentially tomorrow's policy, one is really going to wait for the tone and the commentary from the RBI as opposed to any rate changes, rate cuts.
Yeah, so I think, I mean, at least our house view clearly is that we will not see any significant, change in direction tomorrow. I think, as you rightly said, the tonality and the directionality is something that the RBI could, sort of obviously indicate in its document. But yes, we are not seeing any significant shift from the direction that the RBI has outlined. I think clearly there is a pressure on the currency, and I think the RBI has been very clear in terms of signaling its intent that it will wish to sort of really curb the volatility and smoothen out the position on the currency side. So yes, we aren't seeing any significant shift from the stand that the RBI has taken. So I think at least for the moment or for the short run, we don't see interest rates coming down.
All right, Mr. Pai, thank you very much for taking time out and talking to NDTV Profit there. We're ending this conversation on a bleak note, but essentially highlighting the factors that at this point make the challenges for India Inc. quite sharp and quite difficult there. With that, we're wrapping up this edition of Power Lunch. Thanks very much for watching, but we continue with all the news updates.